Whitney Tilson claims he's no fan of Trump.
I didn't vote for him. I don't support his foreign policy. I don't like his style. And I hope I never have to meet him.
But he claims Trump will make a move that will make some Americans rich.
Someone who has worked at the highest levels of finance in Wall Street for the past 35 years, I'm here to tell you that President Donald Trump could reward a group of American citizens in a unique way very soon.
This is all in his new presentation called US IPO. Whitney is pitching a bunch of stocks he thinks will explode under Trump, and I reveal them here for free so you don't have to buy his newsletter. No paid or proprietary info is given away here, and it's all guesswork based on clues in Whitney's publicly available sales presentation. There's multiple stocks to uncover, so we'll just jump into things. Here's what the headline says. President Trump could reward investors by October 1st with US IPO. The White House is preparing to legally transfer as much as $100 trillion of America's most valuable assets onto the stock market. As the deal goes through, here's how you could profit for just $10. Whitney actually gives away this $10 stock for free in this presentation, and he's talking about Fannie Mae. Here's everything you need to know about investing in Fannie Mae and its future. Fannie Mae is a government-sponsored enterprise and a key player in the U.S. housing finance system, responsible for creating liquidity and stability in the mortgage market. It does this by purchasing home loans from lenders and packaging them into mortgage-backed securities, which allows lenders to issue more loans to home buyers. However, during the 2008 financial crisis, Fannie Mae was placed under federal conservatorship, a move that fundamentally changed its relationship with shareholders and subjected the company to ongoing government control. Despite being under government control, Fannie Mae shares are still available for trading, though only through over-the-counter markets. The common stock trades under the ticker FNMA, and there are also various classes of preferred shares available. However, investors should be cautious. Common shares trade below $1, classifying them as penny stocks with high volatility and limited liquidity. While preferred shares may appear slightly less risky, they still carry significant uncertainty regarding their ultimate value due to the unresolved nature of Fannie Mae's conservatorship. Fannie Mae's stock is considered highly risky primarily because it remains under federal control. Since 2008, the company has been in conservatorship, with the Federal Housing Finance Agency exercising broad authority over its operations. Under the current arrangement known as the net worth sweep, all of Fannie Mae's profits are directed to the U.S. Treasury, leaving nothing for shareholders. As a result, the stock's future value hinges more on legal and political developments, such as court decisions or legislative changes, than on the company's actual business performance or financial fundamentals. The bullish case for Fannie Mae centers on the possibility of its release from federal conservatorship. If that were to happen, the stock could experience a massive rally, as it once traded in the $60 to $70 range prior to the 2008 crisis, representing a potential 60-fold increase from current prices. Beyond the share price surge, a return to private operation would also mean the end of the net worth sweep, allowing Fannie Mae's substantial annual profits to flow directly to shareholders rather than being diverted to the U.S. Treasury. Even if Fannie Mae were released from conservatorship, several risks could limit the upside for investors. A major concern is dilution. Any recapitalization plan might involve issuing large amounts of new equity, which could significantly reduce the value of existing shares. Additionally, the government could impose ongoing regulatory constraints that limit Fannie Mae's profitability, ability to pay dividends, or access to certain markets. Political uncertainty also looms large, as housing finance reform remains a contentious and unresolved issue in Washington, with no clear timeline for action and outcomes that could take years to materialize. When considering an investment in Fannie Mae, it's important to understand the difference between its common and preferred shares. The common stock, trading under the ticker FNMA, offers the highest potential upside if shareholder rights are fully restored, but it also carries the greatest risk, including the possibility of total loss in a restructuring. It tends to be highly sensitive to news and speculation, making it a binary bet on a favorable resolution. Preferred shares, on the other hand, may receive priority treatment in any settlement or restructuring and have benefited from some favorable court rulings. While still speculative, they generally carry a slightly lower risk profile. Each series of preferred stock comes with different terms, trading volumes, and liquidity levels. Investing in Fannie Mae is less about traditional financial metrics and more about betting on uncertain legal and political outcomes. While a favorable resolution could result in extraordinary returns, potentially 10 to 20 times the initial investment, there's no clear timeline, and it could take years to unfold. At the same time, the risk of a total loss remains very real. For that reason, only capital you're fully prepared to lose should be allocated to this highly speculative opportunity. Fannie Mae should only be considered by investors with a high risk tolerance who can afford to lose their entire position without jeopardizing their broader financial goals. For those who are more risk averse, traditional housing-related investments such as REITs or homebuilder stocks may offer more stable and predictable returns. Regardless of your stance, Staying informed is critical. Key developments to watch include policy shifts from the FHFA, court rulings at both the appellate and Supreme Court levels, statements from the Treasury Department, and any movement on housing finance reform in Congress. I'm going to reveal the rest of the stocks in about 20 seconds, but before I do, I want to remind you to click the link in the description to check out Alpha Picks when you're done watching. I reviewed hundreds of stock picking services, and Alpha Picks is by far the best and has crushed the market since inception. Plus, my viewers get a $50 discount you can't get anywhere else. Whitney doesn't give away any more stocks for free, so we have to figure them out. Here's the clues for the second stock. It owns more than 270,000 acres of land in the most resource-rich area of Texas, on top of the Permian Basin. What makes this company so unique is that it has a seemingly endless number of ways to make money. Building data centers, it can make money drilling for oil or natural gas or minerals. It can make money without having to assume the risk of any of the actual drilling. It can even generate profits from sand, water, and even cryptocurrencies. Just to give you a sense of how profitable this company is, last November, a developer looking to build out another new AI data center paid this company a non-refundable $8 million. But the developer wasn't buying property. Instead, they were paying simply for the right to look at and analyze this company's land. I think this could easily become one of the best performing stocks in the market over the next few years. The stock being pitched here is LandBridge, ticker LB. Here's everything to know about this stock. LandBridge is a leading land management company in the Permian Basin, specializing in generating diversified royalty streams from oil, gas, water, waste, and renewable energy operations. The company went public on June 28, 2024, with an IPO price of $17 per share and surged approximately 23.5% on its debut. LandBridge currently maintains a market capitalization of around $4.0 billion, reflecting its prominent position in the sector and its ability to capitalize on multiple revenue streams across the energy and infrastructure landscape. As of July 25, 2025, LandBridge is trading at $53.70 per share, reflecting a 1.8% intraday gain. Year to date, the stock is down 18% from its recent highs, but it remains up 82% over the past 12 months since its IPO, demonstrating strong overall returns despite some recent volatility. LandBridge is currently followed by 8 to 9 analysts, though broad institutional coverage remains limited. Analyst sentiment ranges from mixed to modestly positive, with most models leaning toward a neutral or hold rating. The average price target sits at $62.13, suggesting a potential upside of about 15.7% from the current price, while an alternative model projects a target of $79.80, indicating a possible upside of 48.6%. Analyst price targets vary widely, ranging from $65 to as high as $97.65, reflecting significant variance in expectations for the stock. LandBridge has demonstrated rapid financial growth, with Q1 2025 revenue reaching $43.95 million, up 131% year over year. Trailing 12-month revenue stands at $134.9 million, marking a 77.5% increase, while 2024 annual revenue came in at $109.95 million, up 50.9%. The company is projected to maintain a 3-year compound annual growth rate of about 24.4%. On the earnings front, LandBridge reported a loss of 57 cents per share in 2024, but is expected to deliver earnings per share between $1.70 and $2.05 in 2025 and $2.11 to $2.68 in 2026, translating to an anticipated annual growth rate of 58.7%. The company's EBITDA margin is exceptionally high at approximately 88%, with free cash flow forecasted at around $116 million for 2025 and $176 million for 2026. LandBridge also pays a quarterly dividend of $0.10 per share, resulting in a yield between 0.56% and 0.74%. LandBridge holds a top 3 position among oil and gas land management firms in the Permian Basin, with control of 273,000 surface acres in the Delaware Subbasin. Its business model is built on diversified royalty streams spanning oil, gas, water, waste, and renewable energy, giving the company exposure across multiple sectors. The industry is experiencing strong tailwinds, including rising produced water ratios that are boosting water management revenues and growing demand for water reuse solutions. Additionally, the market's preference for lower capex business models benefits LandBridge, while its non-oil revenue streams provide a valuable hedge against commodity price volatility. LandBridge presents a balanced investment outlook, offering both significant upside potential and notable risks. On the bullish side, the company boasts a rapid growth trajectory in both revenue and earnings, exceptional EBITDA margins near 88%, and a strong projected return on equity of 22.8%. Its low capex royalty model in a highly active basin supports operational efficiency, and analyst price targets point to potential upside ranging from 15% to as much as 80%. However, the stock is also characterized by high volatility, with a beta between 1.5 and 2.0, and is currently down 34% from its $84 peak. Technical buy points have not yet been triggered, and there is limited analyst coverage along with weak institutional accumulation. Landbridge also remains exposed to broader energy price cycles. At around $54 per share, the stock trades below consensus analyst targets and offers compelling growth metrics, but investors should carefully weigh the inherent risks of volatility and sector exposure. Here's the clues Whitney leaves us for the third stock. Right now, my team is excited about a rare earth company that's one of the few without ties to China. It's currently in discussions with the government to build out facilities in the United States. And given how desperate the government is to lock down even more access to these types of minerals, I wouldn't be surprised if it happens quite quickly. When it does, this stock, which currently trades for around $6, could skyrocket. This is likely Lynas, which is a stock Whitney has pitched in the past. Here's what to know about this stock. Lynas stands as the dominant non-Chinese producer of rare earth elements with strategically positioned operations in Australia, Mount Weld, and Malaysia, Kuantan. The company's unique capability to process both light and heavy rare earths establishes it as a critical alternative supplier in the global magnet supply chain, particularly relevant for investors seeking exposure outside the Chinese market. Lynas has shown strong recent stock performance, with its share price reaching $7.08 as of July 25, 2025. Over the past 2 weeks, the stock has gained 11.7%, reflecting strong short-term momentum, while quarterly growth stands at an impressive 25%, indicating a sustained upward trajectory. This recent surge has been driven in part by a major U.S. Department of Defense deal with MP Materials, which has boosted sentiment across the entire rare earth sector and pushed Lynas shares to their highest level since mid-2022. Analyst sentiment on Lynas is mixed, reflecting a range of views about the company's outlook. Of the analysts covering the stock, 6 recommend buying Lynas, seeing strong potential for growth, while 4 suggest holding existing positions, expecting relatively stable performance. Another 4 analysts advise selling, citing possible challenges or concerns about overvaluation. The consensus 12-month price target is approximately $7.15, with projections ranging from more conservative to highly optimistic estimates. Notably, Jefferies recently upgraded Lynas to a buy rating with an $10 price target, citing structural benefits from the recent Department of Defense deal, which has contributed to the generally positive sentiment surrounding the stock. Lynas's recent financial performance reflects both growth and near-term challenges. In the third quarter of fiscal year 2025, the company reported sales of 123 million Australian dollars, about 78.6 million US dollars, which, while representing a 22% year-over-year increase from 101.2 million Australian dollars, fell short of the 155.7 million Australian dollars consensus estimate. Management has cautioned that market volatility may persist. For the first half of fiscal year 2025, net profit dropped sharply to 5.9 million Australian dollars, from 39.5 million Australian dollars the previous year, despite sales rising 8% to 254.3 million Australian dollars, as operating costs surged 29% due to expansion investments. Lynas ended the period with 308 million Australian dollars in cash after spending 267 million Australian dollars in capital expenditures. Operationally, the company achieved a milestone by exceeding 2,000 tons in heavy rare earth production in Q2 2025 and continues to ramp up output. Historically, Lynas has delivered around 10% annual revenue growth and 14.5% earnings growth, with a return on equity of about 2.2% and net margins near 10.5%. Lynas holds a unique competitive position as the only commercial heavy rare earth producer outside of China, a country that dominates roughly 90% of global refining and 98% of heavy rare earth processing. Recent support from the U.S. government, particularly through Department of Defense deals, has improved market fundamentals for non-Chinese producers by establishing pricing floors and boosting investor confidence. Lynas is actively pursuing strategic growth through capacity expansions at MT Weld, Kalgoorlie, and its Malaysian facilities, as well as making breakthroughs in heavy rare earth processing, particularly with elements like dysprosium and terbium. The company is well positioned to benefit from increasing demand in electric vehicles, electronics, and defense. However, it also faces ongoing challenges, including delays in Texas refinery approvals, rising operating costs, and continued pricing volatility in the rare earths market. The investment thesis for Lynas reflects a balanced set of opportunities and risks. On the positive side, Lynas benefits from its strategic geopolitical position as the leading non-Chinese supplier of rare earths, ongoing expansion into high-value heavy rare earth production, and robust demand from sectors like electric vehicles, defense, and renewables. On the other hand, The company faces headwinds from weak rare earth pricing, largely due to China-driven market softness, along with rising capital expenditures and production costs that pressure margins, as well as execution risks tied to its global expansion efforts. Overall, for investors interested in rare earth independence and exposure to structural growth markets, Lynas presents moderate upside potential. However, ongoing financial uncertainty and operational risks support the current neutral analyst consensus, with fair value estimates in the 9 to 10 Australian dollars per share range. And make sure to click the link in the description to get $50 off Alpha Picks. I reviewed over 100 stock picking services, and this one is by far the best. And they don't do any scummy marketing tactics every other company engages in. So if you want to put yourself in the best position to make money with stocks, click the link in the description now.